Does this chart look familiar to you? Where you started out trading shares of stock, and then at some point, either Robinhood or a friend, quote unquote, or Wall Street Bets shat options in your face, and all of a sudden things became an emotional roller coaster where you're sweaty all the time and checking your phone at work, and there's insane highs, insane lows, and you're waking up before your opening bell so you can get your day trades in for the week before you head off to work. And now you're deep in the hole and you're just trying to figure out what out of the money options to buy before an earnings call to leverage your way back up to break even so you can never touch options again and just be a good boy for the rest of your life. Well, I want to tell you a few things. One, right now, stop doing what you're doing. You got into this hole because you're using options a little irresponsibly. And I want to help you use them responsibly to get yourself out of this mess. It's not going to be a quick slingshot back up to profit, but at least you'll get there eventually as compared to completely blowing up your account. Now, this is kind of a painful topic for some people, especially if you're deep in the hole, maybe lost 3K overnight and you're down to the last 50 bucks or whatever. So I'm going to play a slideshow of some puppies just to make you feel better while I explain to you how to dig yourself out of this mess. I'll be brief. Stop trading out of the money options. They are scratch-off lottery tickets and you will blow up your account. 2, stop trading options with expiration dates near in the future. Those have high leverage, they're risky, and you're going to lever yourself straight into the core of the earth and blow up your account. So what are you supposed to do? Trade deep in the money options with expiration dates way out in the future? Well, those are really expensive, and they're expensive for a reason because they have a high probability profit. So if you can keep your portfolio diverse, go ahead and do it. But if you're down to your last 50 bucks and you still haven't even bought your pack of smokes for the day, you might not be able to afford that. So a way to get around this, if you're not doing this already, is by trading spreads. Spreads are an option strategy in which you normally buy an option and sell an option as part of one trade, and they increase your probability of profit, decrease the amount of money needed to enter the trade, and they also allow you to continue using leverage so that you can start snowballing your way out of the hole that you're in a little bit better than just buying like a share of a stock with your last 50 bucks. Now, there's a few things I want to note about this. You want to keep your portfolio diverse, so don't buy spreads that are so deep in the money and so far at expiration that's literally the only trade you have open. Also, you want to trade in the general direction that the stock has been trending in. And I'm talking about like the big overall trend, such as with Visa, it's going up and to the right for the past 5 years. This means that more often than not, it's going up more than it's going down, obviously. So if you're going to trade in the general direction of the stock, then you're going to be more likely to win. And we don't want to do super short term as in days, so you won't be dicked by it taking a quick downturn. Now you also want to let your trades run. You want to enter a trade with the amount of money you enter it with not being that much so that you don't panic sell. Okay? That means usually trading with, people usually say with less than 5% or less in your portfolio. But if your portfolio is tiny, if it's your last 50 bucks, you might be able to get away with it being a little bit more than 5% of your portfolio, because I don't think you can open a spread with $2.50 or whatever. Also, you want to trade options or spreads where the open interest is high, meaning usually over 1,000. The open interest is the number of options contracts that are on the market at the moment. They mean that if there's a lot of those open at the moment, the options that you're buying and selling are very liquid, so you can buy and sell pretty easily. You can find this either by Googling the ticker and right after that typing options chain, and you'll click one of the first 2 links and you'll find open interest in one of the columns, and you can see how much open interest there is. Also, if you look at the bid-ask spread, if it's tight, that generally means that there's high liquidity, so you won't need to worry about that. Okay, so in short, stop buying out of the money options, stop buying options with expirations near in the future, start trading spreads. I have a bull call spread tutorial that you can check out. It's a good place to start learning spreads. There's also information all over the internet about them. I'm going to start a series here shortly that goes over all types of different option strategies, including spreads. And I know other people talk about them, but I like the way I explain it better anyway, so maybe I'm a little egotistical that way. Well, I hope this helps you out some, just give you a little clarity of thought in these trying times. I wish you the best of luck, guys. If you have any questions, let me know. I'm here for you. I'm rooting you on, and I love you.